Greetings, members, one and all of the Salivation Nation. Yet another exciting day in the markets as gold and silver have both rallied strongly. Silver more so than gold, narrowing the gold to silver ratio. And we're going to talk about the reasons why. It has to do with the dollar, it has to do with the bond yields, and it has to do with the Fed. And what the Fed is not doing is what a lot of people aren't understanding. We're going to talk about that in this video as we explore. If you enjoy videos where I talk about the markets and about gold and silver and precious metals, it's a learning, it's always an education, trying to understand what's going on and what the Federal Reserve is doing and how these markets react. A lot of it is based off of psychology. We really cannot make heads or tails of it, pun intended, as these are coins that have heads and tails, although in this case, the tail is very difficult to see on this gold coin because it's covered in a dress. And it has a head on this side too. Go figure. But nonetheless, gold and silver are both up again today. I believe it's another overreaction to what the Fed has stated that many of us had known for quite some time. Investors certainly did, because over 75% of them have predicted that they were going to do exactly what Jerome Powell said in his statement yesterday. I talked about that in the video that I did yesterday on the first big uptick and move when silver went almost doubled its performance from today. Gold and silver prices are sharply higher Thursday, and we saw gold notch a 3.5-month high and silver a 6-month high. It's nice, almost $23. It's $22.85 as I record this video. A dollar index, higher crude oil prices, and a falling U.S. Treasury yields on this day are all boosting the precious metal markets. And a dovish lean by the U.S. Central Bank is also fueling the metals markets today. In fact, if we take a look and see exactly what those things are doing, if we take a peek, we can see that with gold being up over $33, it's $18.03 and 50 cents. Silver is at $22.85, as I mentioned earlier. Crude oil is actually up over 1% to $81.37 a barrel. The Dow Jones Industrial is down, actually, just over a half a percentage point, while the NASDAQ is up 14 points. Very interesting. The dollar index, though, is down over 1.05. It's down almost a full percentage point, and that's having an effect certainly on gold and silver prices. Dramatic. Yes, indeed. And so the dollar index falling is obviously the biggest indicator, and falling U.S. Treasury yields as well. Those are the two things that are going to drive it hard. But what drives them? That's going to be the marketplace and how they interpret Federal Reserve Chairman Jerome Powell's highly anticipated speech at the Brookings Institution that occurred yesterday as leaning dovish on U.S. monetary policy. That's it, folks. He's leaning dovish, which most of us already thought or knew it was going to happen. For those of us who pay attention, that's what's happening. But apparently the markets are really kind of just going a little bit crazy with it, especially with the gold and silver. That rallied the U.S. stock market, pressured the U.S. dollar index, and dropped U.S. Treasury yields. Gold and silver prices rallied in the aftermath of Powell's remarks. He said the U.S. Central Bank could slow the pace of monetary policy tightening as soon as the FOMC meeting in 2 weeks. Let me read that again, because a lot of people are misinterpreting this statement here. They could slow the pace of monetary policy tightening as soon as the FOMC meeting in 2 weeks. Does that mean they're stopping tightening? No, it does not. Does that mean they're going to go back into a loose monetary policy? No, it does not. However, Powell said that the Fed will need to hold policy at restrictive levels for some time. That means that it's going to be quantitative tightening, not loosening. Powell added that inflation remains far too high and the future rate hikes are warranted. Global stock markets are mostly firmer overnight, and U.S. stock indexes are weaker at midday. We did see the Dow down. And so that is the one thing. Now, let me just expand upon this a little bit, because I got a little bit of pushback in my last video about this, because I mentioned in that last video that it was not a pivot. It is not a Fed pivot, and they don't plan on pivoting. And you have to understand exactly what that means. What does a pivot mean with regards to the Fed? Investopedia talks about this. It occurs when the Federal Reserve changes course. It reverses its policy outlook. Let that sink in, folks. It reverses its policy outlook. That's not what Jerome Powell even hinted at in his speech yesterday, even though we know that, that what has happened could lead to a pivot, but we're not there yet. It's going to be quite a while, according to the chairman, that we're going to see that. So it is a reversal or a changing of course. A Fed pivot usually happens when economic conditions have fundamentally changed in such a way that the Fed can no longer continue its prior policy stance. That is the key. And things have not fundamentally changed. Yes, we have unemployment is I think there's going to be some cracks in the unemployment numbers, but not to a great level. They think it's going to be about 3.7% unemployment rate, which means that likely they can continue, at least in the vein that has been predicted for a couple of weeks now. About 75% of traders, according to the Fed Watch tool, think that we're going to continue to see a tightening, but just not as much. So in other words, it'll be a 50 basis point rate hike instead of a 75 basis point rate hike. That is in no way, shape, or form a reversal, according to the definition of what a pivot is. So that's just it. That's the difference here. It's and Investopedia goes on to say the Federal Reserve, as the U.S. central bank, has a dual mandate. You know, it's to maintain both price stability and full employment. And that's the dollar stability. In other words, to rein in inflation. If inflation rises and unemployment falls, the economy may overheat. So the Fed will enact a tight or contractionary monetary policy, such as raising interest rates. That's what they're doing now, to try to slow economic growth and let the economy cool. Likewise, if inflation is low and unemployment is high, the Fed may enact a loose or expansionary monetary policy to stave off recession by lowering interest rates and pumping more money into the economy. This is what they have been doing for the last decade or so. In fact, we had 4 rounds of it, of this quantitative easing that has been occurring one on top of each other. We're paying the piper for that. I disagree. That is a Keynesian model. So once monetary policy has been set and implemented, it can take several weeks or months before the effects of the policy are felt in the economy. Once they are, the Fed typically maintains its existing policy to some degree, or maintains stability and avoids spooking the markets. And that's what they're doing. They're just easing back a bit from this. If the fundamentals of the economy shift dramatically, the Fed is forced to reevaluate its position and may decide to pivot. That is, to reverse its monetary policy stance. Thus, if interest rates are low and the Fed is employing quantitative easing, it would pivot by increasing interest rates and tapering. We saw a pivot when they started to make this move, where this started quite some time ago. That was where the pivot was, to the quantitative tightening or tapering QE. A pivot in the other direction would entail the reverse. So in other words, they would start to print more money again, and they would stop raising rates. That's not happened. That's not what's been proposed. That's not what's even been suggested. So there is no pivot here. And so you have to understand what these words mean in the definition. And we are at a point now where the Fed is starting to wimp out. You can say that they're wimping out, because most of us would agree that they should have done this tightening a long time ago, like in the middle of last year, and even sooner, even before. They should have done this. They should have done it much further back. In fact, one can even make the argument that they should have done it at the end of 2020, or maybe even sooner than that. I don't know, but they're a little bit too late. Jerome Powell, saying that we didn't expect all of this inflation to happen as fast as it did. I mean, you literally would have to be almost an idiot not to see it. I think they really didn't see it, but they were just trying to milk everything for what it's worth politically, and that's just it. The Fed has been politicized really for quite a while, and it's quite unfortunate. That is really the problem, and especially when we see the Treasurer of the United States blaming Americans for inflation and the problems we have today as far as splurging is what her words were in her definition. But nonetheless, that splurging, which is occurring right now, a lot of people are buying extra things in order to protect themselves from inflation, especially non-perishable goods. Can you blame them for getting a little extra roll of toilet paper or something else when we're seeing inflation being with a velocity of about 3/4 of a percentage point a month? Maybe it was up to 1% at one point in time. Can you blame Americans for wanting to stock up? And, and of course, there's a lot of people who can't afford to do that. It's tough out there. And we very well could see the Fed continue to play around with these, with this pulling back a bit here of these interest rate hikes to try to fine tune and walk that thin line between, completely crashing the employment in the economy in some regards, and by doing this and continuing to raise rates, which in reality they've got to raise them about to on par or equal to where inflation rate is now in order to really have an effect, because so far they've not had the greatest effect on inflation. Inflation's dialed back a little bit as far as the rate of increase, but that is only exacerbated by the previous year's high inflation rate that we're now seeing stacked upon a 6.2 inflation rate at a 7.9 or whatever it was. So there you have it. But nonetheless, the Fed definitely is not pivoting at this point, but we are starting to see the markets and folks react to this. So this is why I still feel that though we may see maybe even heading into the weekend continued higher prices, we very well may see $23 silver and maybe $18 or $1,820 gold by tomorrow. I don't think it's going to last long, and I think the weekend, by the time the weekend gets here and I do my Sunday night market watch, I think we're going to start to see these prices correct, and we'll see a correction in gold and silver prices. But who knows? We'll see what happens. That's just my feelings on it. Have I been wrong before? Yes, I could be wrong now because I've been wrong before, but that's just my feelings on it because, again, I've been watching that Fed Watch tool for a while, and it's not changed. Most traders are seeing exactly what I'm seeing. I think it's an overreaction. I think it's just a snap judgment that people are making, and the dollar is reacting to it. We'll see how it rolls out, or how it pans out, rather. Let me know what your thoughts are in the comment section below. I'd like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.